Welcome to ETF Explained, a series on the Get Started Investing podcast. Each episode, we explain one ETF to better understand it and to help you build the skills to analyze an ETF. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited for this episode and this explainer. We are talking about what has to be one of the most popular ETFs in Australia and around the world, really, because this ETF is listed on most markets, wherever you're listening or watching. It's VDHG, Vanguard Diversified High Growth. It's super popular, especially in the FIRE movement.
Big time.
Yeah.
Big time. It's a one-hit wonder, which we'll get to in a moment. But Ren, as always, the purpose of this series is to help you understand ETFs, build the skills to analyze them, and build a portfolio. And it always starts with the name.
Yes, it does.
It does. So what have we got in our name today?
When we say we start at the beginning, we're starting at the very beginning. So the name, Vanguard Diversified High Growth Index ETF. Few things to unpack there. Let's start with Vanguard. That's the product issuer.
Yes.
Next up, Diversified. So this is a good indicator that it doesn't just own one asset. It doesn't just own stocks. It doesn't just own bonds. It doesn't just own property, but there's a mix.
Yeah, I would even go as far as saying it doesn't just own one country within those asset classes.
How good. All right, so that means we have to go under the hood, but that's a marker that it owns multiple different things. It lets you invest in multiple different things with one buy.
What about high growth?
Next up, high growth. Now, this means it will have a weighting towards stocks. In the world of investing, if you think about your retirement accounts, your 401k or your superannuation, high growth is generally going to be sort of 80, 90, 100% stocks. And then you'll have a moderate option, which will sort of be in that 50 to 80%, 60 to 80% stocks, and then a conservative option, which will be less. So that's a bit of investing jargon, but when you see high growth, what you need to know as an investor is it's going to mainly be stocks.
Yes, to the moon. And then to close out, we've got index, which is really an indication of the style of ETF. It's a passive investment approach. There's no one making active investment decisions here. So to round that out, we've got an ETF that is created by Vanguard, diversified across assets and geographies, highly weighted towards stocks with a passive investment approach.
Nice. You can tell a lot from a name.
That's it.
They say don't judge a book by its cover, but do judge an ETF by its name. So let's go under the hood and look at the ETF more specifically. And the place to always go is the ETF issuer's website, because they have to provide a whole heap of information that really helps you analyze the ETF.
So the next thing we want to do is understand the purpose of this ETF. What is it designed to do? And at its core, it's designed to give us low-cost access to a range of different sectors, different asset classes across different geographies, with a tilt towards growth assets. Now, to put some numbers to that, this ETF gives you exposure to 16,000 stocks in one ETF.
Yes.
That is your one-hit wonder.
So because it mainly invests in growth assets, aka stocks, it's designed for investors with a higher tolerance for risk and who are seeking long-term capital growth. Those who want to see their money grow, but are willing to see it fall in the short term because the market is volatile. To achieve that objective, it invests in 90% growth assets, mainly, all shares in this case, and then 10% in a bit more defensive income-producing assets, which are bonds.
Now, before we go any further, it's really important that we kind of pause here and understand how this ETF is constructed. In our last episode, we spoke about the Vanguard Australian ETF, which is constructed of the top 300 Australian companies. This ETF is a little bit different. Not all ETFs are constructed as a basket of stocks like VAS. In this case, this ETF is a basket of multiple underlying ETFs to give you exposure to 16,000 stocks. Fin.
Yes. So what that means is that rather than buying a number of different ETFs yourself, you buy this Vanguard Diversified High Growth ETF, and then Vanguard will essentially put your money with all these different ETFs. So there's 7 ETFs that make up this, I guess, call it an ETF of ETFs. The Australian Shares ETF, international shares, there's a hedged version of the international shares, small companies index fund, emerging markets, global bonds, and then Australian fixed income, which is Australian bonds. And so essentially when you're putting your money in this ETF, Vanguard then go and spread that money across those 7 ETFs, and then those 7 ETFs go and invest in the underlying assets, which, as we said earlier, are those 16,000 shares and some bonds for good measure as well.
Yeah, it's actually like a beautiful wrapping. As we said, this is one stock that we talk a lot about when it comes to the FIRE community, or just a great ETF if you just want to make a simple investment over a long period of time. You don't have to worry about going out and buying each of those individual ETFs that Ren spoke about. It's all wrapped up nicely with VDHG.
Now, there's one important thing to keep in mind here. So this fund of fund structures isn't new when it comes to investing, but they're not very popular because normally they'll charge 2 sets of fees. Each fund will charge a fee, and then the fund that is investing in all these funds will also have a fee. That's not the case with these ETFs. Vanguard just charge 1 fee, and it's not meaningfully higher than any of those underlying index funds. So that's good news for investors, and it solves one of the big problems with the fund of fund structure.
So how does it fit into a portfolio? Because as we've said many times, we see this as a one-hit wonder, one stock for the rest of your life. Like, you can sort of bucket it up how you want. And we really see this as a great opportunity, or a great ETF for that buy and hold over a long period of time. We talk about having a diversified portfolio. We talk about getting access to different geographies, different asset classes. And this stock does that in one simple trade.
Not advice.
Not advice.
No, but I think, look, it's perfectly reasonable, depending on your personal financial circumstances, to say, I'm just going to buy VDHG and I'm going to keep buying it for the rest of my life. And that's all you need to do.
Yes.
I think a lot of people think you constantly need to buy the new thing, but the good thing about these ETF of ETFs is that they encapsulate the whole universe of investing in one easy to buy product. So it's pretty good. There are alternatives out there if if you want the same structure, not with Vanguard for whatever reasons, but it's pretty good.
Yeah, it's pretty good. Anyway, so that's the high level, what the ETF does, its purpose, and why it might fit in your portfolio. But Ren, let's get to the nitty gritty. Let's look under the hood. What index or benchmark is it tracking?
Yeah, so it doesn't track one overall index. As we said earlier, it's got these 7 ETFs that make up this ETF of ETF, and each of those indexes track their own index or benchmark. And this ETF then tracks the cumulative benchmark, I guess, of all 7.
Cumulative performance.
Yeah, but really, like, if you're investing in something like this, you're probably comparing it to the global stock market. The MSCI All World Index is probably sort of the benchmark that you would compare it to.
Yeah.
Even though this has a slight tilt to bonds with 10% in bonds, you're really hoping to get global stock market performance from a ETF like this.
Doesn't get much bigger than 16,000 stocks. What about the fees? You mentioned you're not getting stung for double fees. Where does fees fit into this?
So 0.27% is the fee on this ETF, which is 27 cents for every $100 invested. Now, there certainly are lower fee ETFs out there. Vanguard's Australian shares ETF is 0.07%. But then on the other hand, there are certainly ETFs with higher fees. And so this sort of sits in the midpoint of the fee range.
Yeah, I would say it's compellingly low for a stock that gives you incredibly broad diversification and really, at the end of the day, access to, an investment strategy where you don't necessarily have to think about anything else. 27 cents for $100.
Yeah, I've just had a quick look. One of the other ETFs in the fund is the Emerging Markets Index Fund. That fee is 0.56%. So it's kind of like smack bang in the middle of the range of fees that you might see from someone like Vanguard.
Now, performance. How does this bad boy perform? Over the last year, it has returned 14%. We've been having a pretty good year across many of the major markets that this ETF is invested in, so that's not surprising. When you zoom out and look at the 5-year period, it's returned 8.49% every year for 5 years, or per year on average. On average. But since inception, very similar, 8.5% on average per year each year.
And so when people talk about, you invest for the long term, you might be expecting to get about 8% from the market. These products track the market, and they've done a good job of tracking the market, really.
This is Mr. Market.
It's not, you're not, Warren Buffett getting 20% a year. You're not Renaissance Capital getting 60% a year, but this is the ETF for those who are willing to just slowly dollar cost average over time, build their wealth slowly, and take what the market gives them year after year.
Yes. Now, we always love to look at top holdings. This is where you can see the companies that make up the ETF, perhaps one of the most important skills when it comes to analysing an ETF. But with a fund of fund ETF, it is a little bit different. When you go to the holdings page, you're not going to see individual companies. You're going to see the weightings of the ETFs that Ren spoke about. So when you go to the Vanguard website, what you'll find is a list of all of the underlying ETFs and their weightings against that. So in this instance, about 35% is in the Australian shares index, about 55% is in international index, and then the remaining is in those bonds and fixed income that we spoke about 10%.
And so if you think about how that then flows through, so Bryce just said that 35% of the ETF is Vanguard Australian shares. And then if you look at Vanguard Australian shares, just shy of 10% of that ETF is BHP. So that means 3.5% of VDHG is BHP. And you can do that same with all the ETFs in the ETF of ETFs, in VDHG. You can say, what weighting does it have in this fund? And then if you look under the hood of that next ETF, you can see where your money is actually going in terms of specific companies and how much you're investing in there.
So Ren, a bit of a question for you, putting you on the spot. Pretty sure you're capable of answering it. Why does this fund say they're high growth, but have 10% of the fund towards income producing assets?
Yeah, so high growth doesn't need to be all growth. And so 90% in growth assets is still considered high growth. But why would you have some element of defensive assets or protection? Why wouldn't you just go
100%.
All growth, 100%, let's go?
Like my portfolio.
Is because you want some protection when markets are volatile. And historically, although not always historically, but generally historically, bonds have been a good counterweight in your portfolio for stocks. So in an example where stocks might fall 10% in a year, you'll get some income from the bonds. The bonds actually might go up in value. And so your overall portfolio might only fall 8%. If you go away from high growth and you go to like a moderate growth or a conservative portfolio, when the stock market falls 10% and you have more than 10% in bonds, you might only fall 4 or 5%. And so for people that will panic and sell or, don't want to have their investments in something that will move a lot with the market that's quite volatile, it's a better option. Importantly as well, different people have different time horizons. And as you get closer to retirement, or as you get closer to, that big trip or buying the house or whatever it is that you've been saving and investing for, you don't want all your money in the volatile stock market, because right before you're about to retire, the market might fall 20% and you might have to go back to your boss and say, I'm going to need to work for a couple more years. So that's why people have different asset weightings based on their time horizon and their goals.
Yeah. On time horizon, Vanguard suggests that this ETF is for someone with a time horizon of over seven years or more. And as Ren said at the top, with a risk level that is reasonably high, because to that point, so much of this is weighted towards equities or the stock market. So to close out, if you are looking for dividends or distributions, as they're called on most of these product issuer websites, this ETF does pay dividends. It pays it quarterly, so every 3 months, roughly about a 3 to 4% yield, a little less than the ASX pays out, but that's because it's a global ETF. Not all the companies in this ETF pay dividends, but still nothing to shy away from.
Yeah. Yeah. I mean, you're not investing in this ETF if you want consistent passive income. If we go right back to the beginning and we look at the name of the ETF, it's all about growth. If you want income, well, stay tuned because we'll be talking about income producing ETFs in future episodes. But I think that really sums it up. That's how we start analyzing an ETF. We start with the name, then we go to the issuer's website and we start looking at some of those key points, the purpose, how it tries to achieve that purpose with the index it tracks, its fees, its key holdings, if it's paid any distributions or dividends. So whatever ETF you're looking to analyze, you can do the same thing.
So if you have an ETF that you'd like us to do an ETF explained on, head to equitymates.com/contact and you can leave your suggestion there. Otherwise, slide into our DMs. We're on Instagram. We'll keep a note of what comes in there. But as always, absolute pleasure. We hope you're enjoying the series. If you are getting value out of it, we would appreciate if you could rate and review through your podcast app as well. But Ren, we'll pick it up next episode.
Sounds good.